Welcome back to Stock Spotlight. I'm Michael, your guide to the stock market. In each episode, we analyze companies that have earned a watch or pass rating on my initial research checklist. Today, we're shining the spotlight on TOST Inc., ticker symbol TOST, and uncovering what makes it a potential new investment opportunity. Join me as we explore the insights and strategies that empower savvy investors like you to make informed decisions. Let's dive in. My 33-question checklist evaluates companies across 9 categories, which helps me gain a holistic understanding of the business. So far, I have screened 240 stocks across 9 sectors and 71 industries, with a median quality score of 61% and a top quartile benchmark of 70%. For TOST, I screened them in June 25, and data used for this episode is as of Q3 25. They earned a 50% quality score, which was on the lower end and is in the 24th percentile overall, next to ticker symbol SNOW and ticker symbol CHD. This earned them a watch rating. Let's now discuss their business. There's a couple of industry and sectors that different sources use. So the GCIS mentions financial services, non-bank and insurance industry within the financial sector, but most sources seem to go with software, system, and application industry within the information technology sector, and that is also what I used. As of December 1st, 2025, they have a $20.5 billion market cap, which is in the lower end of large caps, and they have $5.9 billion in trailing 12-month revenue, with a high beta of 1.94. Now, TOST began in 2011 in Boston when 3 founders saw that restaurants were relying on outdated on-premise POS terminals that could not support the expanding digital workflows of modern restaurants. Early versions of TOST were centered on mobile payments and consumer loyalty tools, but the team quickly realized that restaurants needed an integrated, cloud-based operating system that unified front-of-house, kitchen operations, payments, and digital ordering. By 2015, TOST had fully pivoted into a cloud POS with integrated payments. That combination became their core go-to-market strategy. Payments monetization, rather than only software subscriptions, provided the revenue scale that allowed TOST to expand rapidly across small and mid-sized restaurants. Between 2016 and 2019, TOST expanded from a POS platform into a broader suite of restaurant technology solutions, including kitchen display systems, CRM and loyalty capabilities, labor tools, and back-office integrations. They also moved upmarket into multi-unit operators and quick service brands. COVID in 2020 became a further accelerant. Restaurants suddenly needed unified digital ordering, takeout, delivery integration, contactless payments, and online menus. TOST built and shipped new modules rapidly. As a result, active locations and GPV growth surged. The company then went public in 2021 with the mission to empower the restaurant community to delight their guests, do what they love, and thrive. And today, TOST serves more than 150,000 restaurant locations and processes over $50 billion in GPV, or gross payment volume, per quarter. In terms of what they sell, TOST sells a unified restaurant operating system that combines software, hardware, and embedded fintech. The easiest analogy is that TOST functions like the iPhone plus the App Store for restaurants. It is the essential device plus the modules that run the business on top of it. Core offerings include a cloud-based POS system that runs ordering, tab management, table management, kitchen routing, menus, and service workflows. It is the operational command center for both front of house and the kitchen staff. They also have TOST Now, which is a mobile real-time analytics and reporting app that gives owners a live view of sales, labor, checks per hour, and other metrics. Lastly, there's TOST Payments, which is an integrated payments and processing system that includes card present, online ordering, QR-based payments, and more. In terms of who they sell to, they are B2B, and their customers include independent restaurants, quick service restaurants, fast casual and full service dining, bars and cafes, and food trucks and pop-ups. I then like to break down whether their products are essential or not. And I think Toast does sit in the essential category for its customers. If POS or payments go down, the restaurant cannot operate effectively. And it's not really a tool that restaurants can cut during downtimes unless they replace it with a competitor. Looking at customer concentration, this is a unique case because their revenue is highly diversified across customers, but it's very narrow across the restaurant industry. And over time, this may change, which would be a nice tailwind to longer-term sustainable growth. Looking at their business model, there's no CFRA rating, but Morningstar does assign a high uncertainty rating themselves, noting that restaurants are a highly competitive, low-margin industry. The majority of their customers are SMBs, small, medium businesses, which have high failure rates and higher customer churn risk. They also note that Toast depends on continued high growth to justify their valuation, and that competition from legacy and cloud-based POS providers is meaningful. I mostly agree. I'll just add that it's nice to see several 2025 wins with non-SMB big players in casual dining like TGIF and Applebee's. Turning our attention to their revenue generation and quality, Toast generates revenue through three primary streams. The first being financial technology solutions, and these are transaction-based payment processing fees at around 2.5% of card volume, plus fixed per transaction fees. This is recurring in volume terms, but produces low accounting margin, and it includes Toast Capital loan origination and servicing fees. It is the largest reported revenue line item as well. We then also have SaaS subscriptions, which is recurring monthly or annual fees for POS software, analytics, payroll, inventory, and more. Think of it as high quality revenue and high margin. ARR for SaaS is roughly $1 billion, growing at around 30%. They also have hardware and professional services, which are sales of the terminals, the handhelds, kitchen screens, and then installation services. You can think of these as one-time low margin and primarily tied to customer onboarding. SaaS is certainly the highest quality revenue stream to pay attention to, while payments revenue are recurring and tied to daily restaurant volume. Hardware is one-off and low margin. Now, they do recognize revenue different depending on if it's SaaS or payments. SaaS is recognized ratably over time during usually a 12 to 36-month contract. For payments, this is recognized at the point of transaction, and this is important because payments are reported on a gross basis, as Toast does act as the principal, where if they report on a net basis, they would be more like our TTD deep dive in the past. And because they're on gross basis, this means that their revenue is going to be higher, but their margins would be lower. Looking at Toast pricing power, I have this as moderate because switching costs do help and the product is mission critical, along with the cost of everything being a small share of overall restaurant expenses. But I do believe that intense competition that we'll talk about shortly limits how aggressively Toast can push pure subscription pricing increases. Which gets us into our next topic of their moat rating, which Morningstar and Guru Focus both give them a narrow moat, almost entirely driven by switching costs. Then I usually like to look into business segments and geographies, but I will note in their 10K, Toast says that they only have one operating segment. However, for analytical purposes, we will break out those three line items disclosed above. So for the SaaS or subscription services, this generated $706 million in fiscal 24, which was 14% of total and 41% increase year over year. It also contributed a disproportionately large share of total gross profit at 36%, and contribution to gross profit has risen by 5% since 2022. Then looking at financial technology solutions, this was $4.05 billion in fiscal 24, or 82% of total revenue. It increased 27% year over year and contributed 64% to total gross profit. Hardware and professional services was around $201 million in fiscal 24, and that was 4% of total, along with a 14% year over year increase. For geographies, Toast has significant operations in the United States, Ireland, and India, but international revenue is still too small to break out. So any future expansion outside the US would represent new incremental TAM. Just talking a little bit about their sales and marketing, for customer acquisition, they pursue what we call a land grab strategy. And this is essentially why you'll see research online for them talking about how their hardware is basically sold at cost or below cost to get those early restaurants signed. And then once you're signed, they will add on different modules and get that SaaS software going. Toast also does a decent amount of R&D. And if you look at how much they spend in absolute dollars, I compare them to Block since that was the easiest R&D breakout of competitors. And Toast invests around $370 million trailing 12 month versus $3 billion for Block. So quite a bit smaller in absolute scale. Similar story with looking at R&D as a percentage of revenue. For a trailing 12 month, Toast is at around 6.3% versus Block at 12.4%. So nearly double for Block. Toast has been as high as Block in the past, around 2020 and 2021, but their R&D as a percentage of revenue has tailed off the last few years. Now, turning our attention though to my favorite metric, which is R&D efficiency ratio. Anything greater than 1 is usually a good indicator. Toast does perform well here. Their trailing 12-month R&D efficiency ratio of 3.31x compares very favorably to Block's 0.43x. Block has been higher than 1.00x the last 8 years, so this trailing 12-month outlier at 0.43x is something to watch moving forward. While Toast has dropped off from a high of 7.34x in 2022, but has never been below 2.00x since 2020. Briefly, let's talk about their supply chain and operations because inventory is part of the equation here. Their supply chain is relatively straightforward because the company is not a hardware manufacturer, but rather a systems integrator. Their inventory primarily consists of finished goods, such as tablets, handhelds, printers, card readers, and networking equipment, mostly sourced from third-party OEMs. These devices are then configured with their software and shipped directly to restaurants through a very light logistics network. As we know on the podcast, a strong company is only part of the equation. You also need a great industry. So let's take a closer look at the landscape that Toast operates in. I'd personally rate the restaurant technology and POS market as neutral. Using Porter's 5 forces, the environment is rather mixed. Restaurants are one of the largest U.S. industries, which is nice, and demand is structurally going to be supported by the shift toward omnichannel dining, mobile ordering, unified payments, and even labor shortages. However, the industry is also highly competitive and fragmented, with many well-capitalized legacy and software players competing for share. I also think buyers have fairly modest power as well due to low switching costs and thin restaurant margins, and the threat of substitutes does remain elevated. Toast sizes the U.S. restaurant market at around 875,000 locations, where they say they now hold around 13% share. If you include another 280,000 international locations, their global restaurant TAM is at 1.15 million. Now, as at Mavni 5 on X highlights, Toast is also expanding TAM by moving into convenience stores, liquor bottle shops, and some grocery chains, which gives it some nice optionality there, but also execution risk. On the POS side, Toast, their 2024 investor deck, shows that they have around 15% of U.S. restaurant payment volume share, competing primarily with 2 legacy players and 2 cloud-native peers. Also, a third-party read from 6 Sense estimates Toast POS market share at 22% versus 26% for Square and 6% for Clover. So they certainly appear to be in the driver's seat in market share for both restaurant locations and POS payment volume. Independent industry researchers expect the restaurant POS market to grow at a mid to high single-digit pace over the next decade. Grandview Research estimates the POS market will grow at around a 6.9% CAGR through 2030, while Market Research Future projects a global restaurant POS market CAGR of 8.6% through 2035. Against that backdrop, InvestorsGrow.com curated analyst estimates for Toast, and they have them growing at 16.8% through 2029, which is roughly 2 times the industry growth rate. That growth spread implies Toast continues taking revenue market share with an annual growth rate advantage of 800 to 1,000 basis points. Now, turning our attention to the competitive environment. They do operate in one of the most competitive segments of fintech and restaurant technology. Block, or ticker symbol XYZ, competes through Square, which offers POS hardware, software, and payment processing for small businesses across many verticals. Square is also their closest competitor in the SMB POS category, with comparable hardware, strong brand recognition, and a broader merchant base. The buyer dynamic favors Square when merchants want a general system across multiple industries, while Toast seems to win inside restaurant-specific workflows. Fiserv, or ticker symbol FISV, is a global payment processor and merchant acquirer that competes with Toast through Clover, which benefits from their large acquiring footprint and bank distribution. However, Clover is less specialized in full-service restaurant operations, which I believe reduces their competitiveness against Toast's deeper restaurant operating system. There's also Shift4, or ticker symbol FOUR, which focuses on integrated payments and POS for a variety of industries, specifically hospitality, stadiums, entertainment venues, and some restaurants. While Shift4 competes most directly on payments rather than a full restaurant software suite, its momentum is notable. They currently have the fastest GPV growth in the group as of Q3 25 at 25.7%, outpacing Toast 23.5%. There's also Adyen, ticker symbol ADYEN, and this is a global enterprise payments platform optimized for omni-channel commerce and large multinational merchants. And I've personally seen them at Dick's Sporting Goods and Lego stores. They don't directly compete with Toast in restaurant POS software, but they're worth noting here as they set an upper limit on Toast's TAM. So looking at this competitive set, I looked at some customer metrics in Comparably and some financial metrics in Fiscal AI. Toast sits right at the average and median for customer loyalty at 78%. And interesting enough, Shift4 leads the group at 81%. And then on NPS, however, Shift4 trails the group at a minus 24, while Toast, Block, and Adyen are around plus 24 to plus 26. So overall, Toast does pretty well on both customer loyalty and NPS. It also stands out on financial metrics with the strongest historical growth profile, posting a nearly 50% 5-year revenue CAGR and nearly 80% 5-year gross profit CAGR, far ahead of the competitive set. Forward expectations still remain robust, with analysts projecting 20% revenue CAGR and 46% EBITDA CAGR over the next several years. Only Shift4 and Adyen have slightly higher forward revenue CAGRs, while only Shift4 is close to Toast on forward EBITDA CAGR at 36%. Valuation is higher for Toast on EV to GP. It's around 14x or so versus 8 times for peer median, and forward EV to EBITDA at 29x versus a 12x peer median. And only Adyen commands a similarly high premium at 19x and 20x respectively. For me, Shift4 might be the most intriguing here purely on the numbers, as they have a strong historical and high forward growth rates at a lower valuation. Now, I usually look at a company's quality growth profile in these deep dives, but Toast is difficult to assess through my usual backward-looking lens because the company is still early in its financial maturation, only turning GAAP profitable in 2023 and having public financials dating back to only 2019. With that caveat, revenue predictability does screen reasonably well with a revenue stability score currently of 0.89, which is above my 0.84 benchmark. Although its SBC adjusted free cash flow linearity has been not surprisingly low with a R squared of 0.13 for the last 6 years. For value creation, we set that section aside entirely as Toast is not yet at the stage where ROIC trend direction, or even value compounding rate provide a fair or useful assessment. We'll now dive into a high-level overview of their 3 financial statements. First, the income statement. Revenue per employee has compounded around 17% since 2021, rising from about $538,000 to $1 million per employee on a trailing 12-month basis, While they're still early in their operating leverage journey, this steady climb is nice to see. From a margin perspective, they report payment processing on a gross basis. So remember that their GAAP gross margin is not really an informative metric. Instead, focus on operating margin and net margin, both of which turned positive in 2024 and currently trend at around 5% trailing 12 month. Looking at their cost basis, COGS is dominated by the financial technology solutions line, which accounted for around 84% of COGS in 24. Now, COGS as a percentage of revenue has improved meaningfully, falling from 83% in 2020 to 76% in 2024. This steady decline is nice to see, but it's still relatively high due to the fintech piece. What I like too is that TOST gives a clean breakout of 3 operating expense pillars. As a percentage of gross profit, sales and marketing is the largest bucket, now at 39% in 2024, and R&D is number 2 at 29% of gross profit, reflecting that high R&D need for the business. And then a little lower, G&A is at 26% of gross profit spend in fiscal 24. It's worth noting that all 3 have been trending steadily downward since 2020, showing that TOST is gaining operating leverage as it scales. Still, I'd like to see S&M below R&D over the long term. Let's now turn our attention to the balance sheet. Their balance sheet is dominated by liquid, operating-driven assets rather than acquisition-driven intangibles, which is exactly what you want to see in a young, scaling software plus payments company. From 2019 to 2024, cash and equivalents median was 58% of total assets. This reflects a healthy liquidity buffer and the company's historically strong capital raises. Accounts receivables remain stable at a low 3 to 5%, and inventory has also been around 5%, rising temporarily in 2022 to 7.4% of total assets, and then normalizing back to 4.9% in 2024. What's also nice to see is that goodwill is held steady between 4 and 7% of total assets, well below software industry norms and far below my 30% threshold. TOST's liability structure is dominated by accrued expenses and other current liabilities, which reached 83% of total liabilities in 2024, up from 32% in 2019. The 10K breakout shows that this line is not traditional operating leverage, but largely pass-through obligations tied directly to their payments business. Accounts payable is small and stable at 4 to 5% of liabilities, and deferred revenue sits around 6 to 7%, which is pretty normal for subscription-based SaaS-like models with monthly billing. TOST carries no outstanding debt as of year-end 2024. They have a 2021 senior secured credit facility that remains fully undrawn with $325 million of available borrowing capacity. The only long-term contractual obligations of note are operating leases with about $34 million in present value. This is reflected in low debt to equity, high cash to debt, and low debt to free cash flow ratios. Turning our attention to the cash flow statement, their operating cash flow has finally turned the corner, improving from $135 million in 2023 to $360 million in 2024. Looking then at free cash flow conversion, while it is still very volatile as a metric for TOST, the trailing 12-month free cash flow conversion at 209% is nice to see, and there definitely is high free cash flow conversion potential with this business. I rate SBC intensity as medium, as their SBC as a percentage of revenue has fallen from 10.4% in 2020 to 4.2% trailing 12 month, well below the industry average of 8% and my 10% benchmark. It's worth noting that SBC percentage of operating cash flow is a little noisier and higher, but directionally improving. I then rate their capital intensity as low, as CapEx has held between 0.9% and 1.4% of revenue for 6 straight years and is below the industry benchmark and my 4% benchmark. Let's talk about who's actually steering the ship at TOST and whether their incentives line up with long-term shareholders. So as we know in this podcast, I like to classify all CEOs into a classification system of the most knowledgeable and passionate about the business, being founder-led, to the least, being hired hand. And Toast falls into the founder-led leadership category. I'm probably going to pronounce his name wrong, but Aman Narang, their CEO as of January 2024, is a co-founder of the company. It's worth noting that he has only been in the role less than 2 years, so this is something new for him and the company. Turning our attention to employee sentiment, which I use Glassdoor, they have some pretty solid ratings across the board, with a 71% recommend to a friend rating and over 1,500 reviews, which is right at my database median of 72%. Their CEO approval rating is 74%, and 68% of employees have a positive business outlook. Looking now at how they're paid, the leadership team is paid in a way that I do believe aligns with shareholders. The CEO earned around $11.3 million in 2024 with the following breakdown. $400,000 in base salary, which was about 3.6% of total pay, $10.4 million in equity awards, which is combined stock options and RSUs, and then an annual cash bonus of $506,000 that was driven by bonus funding at 136%. So this means that around 96% of the CEO's pay is at-risk equity or performance-based bonuses tied to revenue growth and then adjusted EBITDA, which is the compensation model you want, although you can pick apart some of these metrics. The CEO also owns around 3% of Toast, which does give him some skin in the game as well. Looking at capital allocation, Morningstar actually gives them an exemplary rating for their business lifecycle. Toast has never paid a dividend and only launched its first stock buyback in 2024. The scale is still small at about $56 million of buybacks on $300 or so million of free cash flow last year, or roughly 18%. Morningstar does anticipate repurchases staying modest until around 2027, when they expect falling stock-based comp to let the share count finally start drifting down. Speaking of share count, shares outstanding did grow from 195 million in 2019 to 629 million today, an increase of more than 200%. But remember, they did IPO in 2021. On the M&A front, they have done some small tuck-ins since 2019, but their reliance on acquisitions has generally been very low. Let's now dive into a few key metrics that are critical to monitor for Toast investors. The first, gross profit contribution mix between SaaS and fintech. To me, this is the KPI that captures the core of the Toast thesis. Because revenue is distorted by payment pass-through, gross profit dollars reflect economic reality. Investors need to see whether SaaS is expanding as a share of the GP mix, because SaaS is far higher quality, higher margin, and more predictable. As of fiscal 24, subscription was 36% of gross profit, and fintech was 64%. The second KPI that I would track is ARR per location, which gives you an unit economic lens. And ARR per location is the purest indicator to me of how much Toast monetizes each merchant, as it captures software, payments, and cross-selling into one metric, which makes it a great proxy for how the economic model scales per store. Latest data is around 2.016 billion in trailing 12-month ARR at 156,000 locations, which gives you a 12,925 ARR per location. Let's now move on to valuation and technicals. Given Toast's current growth stage and the fact that free cash flow only recently turned positive, the business is still hard to value cleanly. Across the payments landscape, Toast sits in a true hybrid position with around 40% of gross profit coming from SaaS, which is higher than most other competitors, unless you include XYZ's services and subscription segment. So, with that said, I'll use a blend of DCF and multiples to triangulate a fair value range using a current price of $35. For the DCF, I ran a 10-year DCF using analyst free cash flow estimates from 2025 to 2027. This is 52 analysts in total. For years 4 through 10, I applied a 24% annual free cash flow growth rate that dropped to 10%, which I do believe is reasonable given their stage of scaling. This takes free cash flow to about $2.3 billion by 2034. Using a 9% discount rate and a 2.5% perpetual growth rate after 2034, the model produces a fair value of $43 per share, which equates to around a 10 to 11% expected IRR at today's price. For EV to gross profit, TOST currently trades at a 12x trailing 12-month multiple, and this is compared to its 4-year median of 16.3x. If we simply re-rate the business back to that historical median and apply it to today's trailing 12-month gross profit and share count, we get an implied value of the same $43 per share. However, as we know, that's no guarantee, as the business was also much faster growing back then. If you assign TOST a more conservative, say 10x multiple, the implied value drops to around $28, which means they would actually be 20% overvalued. For context, peers have historically traded lower on this metric. Block sits at near 3.6x trailing 12-month, and Shift 4 is around 7.6x. Looking at forward EV to sales on fiscal AI, on a next trailing 12-month basis, TOST is trading at 2.6x sales, which is slightly below its 4-year median of 2.9x, suggesting that the market is already pricing in a slower revenue growth profile compared to its earlier years. However, that still values the company at a premium to peers like Block at 1.4x and Shift 4 at 1.9x. Before we get to the verdict, let's briefly talk some technical analysis at the current price. For trend analysis, I'm using linear scale plus daily data for the 1-year view and a log scale plus weekly data for the 5-year view. So on the daily 1 year, TOST trades below the 50, 100, and 200-day EMAs, but it has reclaimed the 20-day EMA, which is the first step in short-term stabilization. The broader daily trend remains down, but holding above the 20 EMA is at least a mild positive sign in the near term. Looking at the weekly 5-year, TOST is above the 100-week and 200-week EMAs, but still below the 20 and 50-week EMAs. That keeps the long-term trend technically weak, with the stock sitting between long-term support and meaningful intermediate-term resistance. My stage analysis spreadsheet currently places TOST in stage 4 on the 1 year and between stages 3 and 4 on the long-term chart. A key level to watch is the 1-year 50-day EMA at 36.56, because reclaiming that level would be an early signal that a potential transition towards stage 1 might be forming. An interesting buying zone on the 5-year chart sits around $31 to $33, and short interest for TOST is 5.62% as of November 25, which does fall into my neutral 5 to 10% category. All right, now let's get to the verdict. For TOST, everything ultimately hinges on free cash flow, and the range of outcomes is still wide given limited years of positive free cash flow. I won't do a 5-year total shareholder return analysis, but a rough 2-year TSR using analyst estimates through 2027, which is 11 analysts, has free cash flow per share compounding at roughly 27 to 29%, even after applying a negative 0.4% buyback yield to reflect moderate net share issuance. That, combined with a starting free cash flow yield of 2.7%, which is just the inverse of their 36.5x price to free cash flow multiple, and a modest multiple compression down to a 30x target by 2027, gets you a TSR of 25% plus. However, this path assumes steady execution, consistent share count discipline, and no step back in free cash flow, which is not guaranteed. But if TOST continues scaling ARR per location, expands SaaS gross profit contribution, and maintains strong net retention rates, the setup resembles the classic optionality slot in a portfolio, complementing the more resilient compounders. For me, I already own MasterCard, and I believe that their industry has fewer questions than payments right now. Across DCF, EV to GP, and forward EV to sales, the fair value range clusters between $28 and $43. On the technical side, $28 aligns with the long-term 200-week EMA and a multi-year volume support level, while the $36 to $38 zone lines up with the 1-year 50-day EMA and a major volume shelf. Bottom line, TOST does not yet meet the criteria of a quality growth compounder that I'd size heavily in my portfolio, but it does screen as a credible optionality play. Before jumping in, I'd like to research competitor 4 more closely and wait for a price closer to $30 or lower for that additional margin of safety. But this is my situation, as I have a full portfolio of 21 holdings, and for someone in a different position, now could be a good entry price. And that wraps up today's episode of Stock Spotlight. I hope you found my analysis of TOST both insightful and actionable. If you enjoyed today's episode, drop a comment or take the episode poll. For real-time updates, follow me on X at invest091. Join me next after the new year when we'll dive into my philosophy around exiting positions before we do a deep dive on Viva Systems Inc., ticker symbol VEE. Until then, keep your investment smart.